My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Welcome to September, the most treacherous of months. Now, look, there's no evil magic to it, but you should get used to days like today. Dow shed 69 points, S&P declined 0.13%, but the Nasdaq lost 0.57%.
The House of Pain.
Because I believe there'll be far more of them than we've come to expect ever since the bottom 18 months ago. Why am I so concerned about the weeks ahead other than the self-fulfilling prophecy that September does tend to be rough and it's been ages since we've had a real decline? Let's not waste time. I'm taking them right down. One, earnings. That's right, earnings. Call me old-fashioned, but I think the stock market is very much tied to how companies are actually doing. These numbers have been phenomenal for ages. We've gotten spoiled by upside surprise after upside surprise. Today, though, we've seen the nasty side of earnings surprises, the downside ones. And let me tell you, they're no fun at all. And we're not prepared for the damage. Two venerable companies, Sherwin-Williams and PulteGroup, both pre-announced disappointing orders. Hey, you know what that is? They disappointed earnings, top and bottom line. Why? Supply chain problems and raw cost inflation. Wow, it's a paint company and a home builder. That comes on top of yesterday's ugly pre-announcement from PPG, the coatings company that hit us with its second shortfall in a row for the same reasons. The raw cost problems now includes the price of natural gas, something we haven't had to worry about for a long time. You know, it used to hang around $3. Now it's approaching $5. That's way too expensive for a fuel that dominates our nation's power supply, serves as a basic building block for so many chemicals. The good news, none of their stocks got crushed because demand's still in good shape. That's right. I mean, they're still getting business. The bad news, these supply problems, they're not going away. Seems like they've become ingrained. No wonder the Federal Reserve's beige book out at 2 o'clock today, the board's assemblage of reports, showed continued elevation of inflation. It's just true. We're stuck with it, man. That brings us to problem number 2. The Federal Reserve has made a big bet that inflation would be transitory. That's why they've continued buying bonds, keeping interest rates low. However, after these pre-announcements, where we keep hearing about rising raw costs, don't you have to wonder if inflation's more intractable than they thought? It's like that semiconductor shortage has confounded so many different industries, leading to higher prices practically everywhere you look. That's going to put tremendous pressure on Fed Chief Jay Powell to raise interest rates. And that is still among most people's worries, more than earnings shortfalls where I'm concerned. Hey, look, this is the way people think. This is how Wall Street thinks. You want to fix the housing shortage? Raise mortgage rates. You want the semiconductor shortage to come down? Well, people buy chip-filled cars with borrowed money. Raise the cost of that money, the demand will dry up. Yes! Higher rates are the magic elixir that can break the inflationary cycle, but they do that by destroying demand, and that crushes earnings, which in turn crushes stocks. Third, if rates are headed higher, that creates more competition for high-yielding dividend stocks. These days, not many stocks are supported by their yields, but there will be even fewer if rates go up. Today, we got a bit of conundrum. The stocks with the best yields rallied, perhaps because we're still in the aftermath of last Friday's anemic employment number. We also saw an upside surprise from the dividend kingpins today. General Mills told a rapt audience that business was coming in at the high side of its estimates, partly because of strong pet food sales. Well, the pin action, of course, was overwhelming, and that group sent the whole food cohort higher. Talk about bad leadership. Those are the recession stocks. Let's hope that after the close, Lululemon's great number and RH's numbers change the complexion of this market. But if you throw in the rally in the utilities, it feels like many investors have already given up on this economy. They think the Fed will throw us into recession. I disagree with that analysis. But if you believe we're at the beginning of a new rate hike cycle, then buying the recession-resistant stocks make a ton of sense. You certainly won't want to hear from Cleveland-Cliffs later in the show, one of the largest steel companies in the country. Well, then we've got a problem that I regard as being, who would have thought this just a few months ago? Yeah, too much stimulus. The president and his allies in Congress want a gigantic stimulus package on top of the smaller bipartisan infrastructure bill. That would supercharge the economy, but it also cause major wage inflation, which is good if you work for a living, but bad if you own stocks. We already have 10 million unfilled jobs. However, if that big stimulus package gets killed, the investors who are dependent on it and what it would do to companies they own, well, I got to tell you, those people will be disappointed because without this, well, you can't prop up the cyclicals. Either Congress passes this thing and the Fed will have to tighten in order to tamp down inflation, or Congress fails and the economy, or at least the cyclical part, will get hurt with no federal support. Of course, there's one way out of this dilemma. It's just not a good way. If the runaway Delta variant causes enough of a slowdown, the Fed won't need to slam the brakes on the economy because the pandemic will do the job for them. Talk about a Hobson's choice, higher rates or more COVID. Either way, the economy gets hurt. I'll take a rain check on both. All that said, the natural buyers, the people who send their money into the mutual funds every month, by nature, that usually sops up the excess supply created by all the selling. But if you think there's enough money on the sidelines to support these prices, you still need to reckon with the nightmare of excess supply from all these endless IPOs. Now, I am on the floor of the stock exchange every morning, and I am overwhelmed by the number of companies coming public. And I love companies. And that's whether through ill-formed and ill-advised SPACs to raw money losers. Companies with little to no hope of turning a profit. But they have catchy names and good ad campaigns, so that they come public anyway. Remember, I've always said that new supply serves as a wet blanket, dousing the fire of the buyers. Of course, this IPO cycle will eventually play out like they always do, with a sell-off that lowers all prices to levels where stocks are more attractive. We can't seem to stop this deal flow. Incredible, given the awful performance of most SPACs. Unfortunately, there's too much money to be made creating these things. The investment bankers won't let up until the golden goose of public money is slain. They'll kill it. That takes time. Finally, there's one last worry that just can't seem to stay on the radar screen, no matter what I do to talk about it, and that's China. After decades of communism in name only, President Xi has decided to go all in on, and I quote, common prosperity. He's sounding more like Chairman Mao, certainly more than any Chinese leader since, Mao. It's very bad for business, but honestly, I'm much more worried about China's horrific human rights track record. Most of all, I'm concerned that this authoritarian turn will embolden him to keep putting pressure on Taiwan, possibly doing something crazy like invading, or at least invading some of the nearby islands. If there's a conflict in the Taiwan Strait, that jeopardizes the whole semiconductor supply chain because we buy so many chips from Taiwan Semi. More importantly, this is the kind of thing that could set off World War III. To loosely paraphrase Sun Ra and his outer space orchestra, nuclear war, it's bad for business. Here's the bottom line. At the end of the day, I think we can deal with any of these issues, but not all at once, at least not without lower stock prices. And lower stock prices is what September's all about.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.